Morgan of SunWest Mortgage is here to change the world of loan originations forever. From sending updates to your clients to allowing you more time, you can do it all in a simple chat. You no longer have to struggle with documents. All you need to do is select the files and upload them, and they're submitted in an instant along with your loan file. With SunWest, your true home is always within.
Welcome to The Interest. I'm Mike Savino. With rates bouncing around, you'd think potential homebuyers would shop around to see what options there are. And while most do, there's a sizable chunk that's not doing that. For customers who aren't talking to multiple originators, how do you make sure that yours is the quote that they get? NMP staff writer Sarah Wallach gets some tips in this edition of Ask an Expert.
It doesn't seem like whatever tools are being put out there are not fundamentally changing the way people behave.
Lenders and originators offer more tools than ever, letting potential homeowners shop around. But some aren't doing that exploring. A recent survey by Fannie Mae found 36% of borrowers are only getting one quote.
But it's not the highest focus, right? The highest focus is shopping for a home, finding the right home.
Fannie Mae Deputy Chief Economist Mark Palem says that the number is consistent. It was 35% back in 2014, and 39% of those who don't shop say it's because the quote leads to a good relationship.
Borrowers are often quite comfortable with the lender that they're working with.
So how do you make sure it's your quote they see? It's obviously important to market yourself, and rate estimate tools are important to some buyers. But so are tried and true methods, like getting referrals from a real estate agent.
People do shop online, so it's kind of a mix of things, but I wouldn't underestimate the importance of trusted advisor referrals.
Fannie Mae saw little difference between first-time and repeat buyers. Palem admits he was surprised by this.
I would have thought maybe the repeat buyers would negotiate more because they were more familiar with the process.
Of course, once you establish yourself as that trusted advisor, you have a leg up on the competition when that buyer looks to upgrade to a new home. That's especially true for buyers who don't get multiple quotes.
There is definitely an element of once you build a relationship and you feel like it went well, you're going to naturally go back to that loan officer.
And Fannie Mae's study found that the topsy-turvy market hasn't altered this trend. Palem says buyers are only slightly more likely to shop for rates. It's not a significant change.
The movements are small compared to the dramatic movements we've had in rate, so I don't really think this is rate driven.
You can hear more from Palem on The Principal, the Mortgage News Network's daily podcast, available wherever you get your podcasts. For the Mortgage News Network, I'm Sarah Wallach.
Thanks, Sarah. Buyers will need help finding the right loan because affordability remains at a level we haven't seen since the 1980s, even with rates sliding back down. According to Black Knight, the typical mortgage on a newly purchased home gobbled up just over 37% of the median household income. That's down slightly from the prior month, but it still remains close to a 40-year high. That's because while rates have come back down, prices remain high and inventory is still low. Homeowners are less likely to put their homes up for sale if they have a mortgage with a rate that's significantly lower than the current market. We still had a 40% deficit in housing stock in October. That is down slightly from September, but inventory had been making improvements over the summer, and those improvements seem to have stalled. Black Knight says this is creating a gridlock in the housing market that you don't normally see when rates are starting to slide. Coming up, the ongoing gridlock is also causing a huge drop in activity for Fannie and Freddie.
Don't miss the largest regional mortgage show in the nation. The New England Mortgage Expo returns to Mohegan Sun in Connecticut, January 12th and 13th. See us at www.nemortgageexpo.com. Start your year with the best connections in the industry. Dozens of sessions, scores of exhibitors. It's where success is written every hour. www.nemortgageexpo.com.
Welcome back. Fannie Mae and Freddie Mac are acquiring fewer mortgages this year thanks to rates spiking, and the gap is huge. In its third quarter mortgage default index, Milliman notes that Fannie and Freddie acquisitions were down 62% from the third quarter of 2021. The plunge is driven by refis, which in the third quarter were down 87% year over year. That drop in refinances is also causing a change in defaults, which were roughly a half point higher from the second quarter of this year, at least in regards to defaults of government-backed loans. That's likely because purchase loans are at more of a risk for default, and they're making up a larger share of a shrinking market. Milliman says this risk of defaults is only likely to increase, with the market slowing down even further and refi activity continuing to drop. We'll be right back with what else is interesting. Welcome back. Here's what else is interesting today. A surprising number of homeowners remain underwater right now, and the majority of them purchased their homes just as the market was peaking. Now, the number of mortgaged homes with negative equity is dropping from its peak of 10% this summer, but at around 3%, it's still way above where we were a year ago. And of the 450,000 homes underwater at the end of the third quarter, nearly 60% were purchased this year. On top of that, another 1 million homeowners who purchased this year have less than 10% equity. For more on these and all of today's top stories, go to mortgagenewsnetwork.com.